I'm going to tell you a story. It's a story about a man, let's call him David, who managed to do something truly remarkable. He took a lifetime of hard work, 30 years of grinding, sweating, and building, and he incinerated it. Poof, gone. He didn't lose it because of a market crash. He didn't lose it because of fraud. He lost $40 million in 6 months because he was smart enough to build a fortune, but too stupid to keep it. You see, getting rich is relatively easy. A lot of idiots get rich, but staying rich, that requires a different set of mental models entirely. And most of you listening to this right now, frankly, you don't have them. You are sitting on a powder keg of your own ignorance, waiting for a spark. David called me at 2 in the morning. He was crying. He said, "Charlie, I don't know what to do. I have nothing left." Now, I don't have much patience for self-pity, but I listened, and as he spoke, I realized he had fallen victim to a classic Lollapalooza effect, a confluence of bad psychological tendencies, all hitting at once. Greed, envy, denial, and the worst of all, leverage. He had $40 million. He was set for life. He could have sat on his ass and collected dividends until he died. But he saw a deal, luxury condos, a can't-miss opportunity. He wanted to turn that 40 into 100, because 40 wasn't enough, apparently. So what did he do? He did exactly what I tell you people not to do. He went all in. He borrowed against his assets. He stripped his liquidity. He made himself fragile. And when the interest rates ticked up just a little and the construction costs doubled, he was caught with his pants down. He was wiped out now. Why am I telling you this? Do I enjoy watching people fail? But I am telling you this because you are likely doing the exact same thing on a smaller scale. You are chasing returns, buying that rat poison you call Bitcoin or day trading options because you want to get rich now. You want the brutal truth. You are probably going to lose unless you learn the one concept that David ignored, the concept of anti-fragility. I'm 99 years old. I've been rich longer than most of you have been alive. Warren and I have survived recessions, wars, stagflation, and the dot-com idiocy. We didn't survive because we were brilliant predictors of the future. We survived because we structured our affairs so that we couldn't die. In the next 45 minutes, I'm going to scold you. I'm going to show you how to invert the problem, how to destroy your wealth, so you can understand how to protect it. If you can't sit still for 45 minutes to learn how to save your financial life, then go ahead and click off. Go watch a cat video. You're already hopeless. But if you have a shred of rationality left in you, stay put. Let's use a little it's a trick I learned from the great algebraist Carl Jacobi. Invert, always invert. Instead of asking, how do I get rich? Let's ask, how do I guarantee I go broke? It's actually quite simple. If you want to go broke, you should put yourself in a position where a single event can wipe you out. You should dig a hole so deep that you can never climb out of it. Here is the arithmetic of stupidity. If you lose 50% of your wealth, what return do you need to get back to? Even most people, the ones who didn't pay attention in 4th grade, instinctively think, well, 50%. Wrong. You need 100%. If you have $1 million and you lose half, you have $500,000. To get back to $1 million, you have to double your money. Do you know how hard it is to double your money without taking insane risks? It gets worse. If you lose 75% of your money, you need a 300% return to break even. If you lose 90%, you need a 900% return. When you lose 90%, you are working at the car wash until you're 85. David violated this first principle. He took a risk that had a probability of total ruin. I don't care if the probability was 1%. If the consequence is ruin, you don't take the bet. At Berkshire, we have a simple rule. We will not risk the firm ever. We will we will look stupid for a while, but we will not bet the farm. Now, why is this so hard for brilliant people to understand? Why did David, a lawyer and successful developer, not see this because of envy? He saw someone else getting richer faster than he was, and nothing drives a man crazy quite like seeing his neighbor, who is stupider than he is, getting rich. David put 100% of his chips on the table. He concentrated his bets now. I've said before that diversification is for people who don't know what they're doing. And that's true. Warren and I concentrate, and this is a big but, we concentrate in things we understand. And we never ever use leverage that could wipe us out if we are wrong for you. The average retail investor, you should be terrified of concentration. You are not Warren Buffett. You are not me. You are likely someone with a job and a retirement account. If you put more than 25% of your net worth into a single speculative idea, you are begging for the market to take your money. I've never had more than a calibrated percentage of my net worth in a spot where it could disappear overnight. Even when I loved a deal. Why? Because I have worldly wisdom. I know that the world is uncertain. I know that I could be wrong. So, write this down if you know how to write. Never position yourself so that you can lose everything. It sounds obvious, yet the cemeteries of Wall Street are full of men who ignored it. Let's talk about optionality. David lost because he had no options. When the market turned against him, he had to sell. He had to borrow. In the financial world, being a forced seller is like bleeding in a shark tank. You want to be the shark, not the bleeding idiot. How do you become the shark? You need liquidity. You need cash. I hear these financial advisors on television, people who couldn't beat the S&P 500 if you gave them the answers in advance, telling you cash is trash. They say you have to be fully invested at all times to beat inflation. That is asinine. Cash is not just a piece of paper that loses 3% a year to inflation. Cash is an option contract. It is the ability to buy assets when everyone else is selling them. In 2008, when the world was ending, when Lehman Brothers was collapsing, and people were crying in the streets, Warren and I were sitting on billions of dollars. We weren't panicked. We were salivating. We bought Goldman Sachs. We bought General Electric. We got terms that were obscene because we were the only ones with the checkbook. If we had been fully invested like the academics tell you to be, we would have been crushed. We would have been selling at the bottom just to survive. David had zero liquidity. He ran his life at 100% efficiency. No slack in the system. You need slack. You need to keep 20% of your net worth liquid. Yes, I said 20%. Oh, but Charlie, I am missing out on gains. Be quiet. You are paying an insurance premium for the ability to survive. If you have cash, you are anti-fragile. When the market crashes, you get stronger because you can buy cheap. When you have no cash, you are fragile. When the market crashes, you break. Now, why is this so hard for brilliant people to understand? It's because you lack patience. You have the attention span of a gnat. You want the result now. Blaise Pascal said, all of humanity's problems stem from man's inability to sit quietly in a room alone. I have made more money by sitting on my ass than I have by working. I wait. I wait for the fat pitch, and while I wait, I keep my powder dry. If you are living paycheck to paycheck, or if every dollar you own is tied up in your house or your 401k, you have no optionality. You are one bad medical diagnosis or one recession away from ruin. Build the cash pile. Ignore the inflation hawks. When the next crisis comes, and it will come, that cash will be worth its weight in gold. Let's move to the third way you ensure you don't end up like my friend David. David made high income, but he had no wealth. There is a difference. High income means you are a well-paid hamster running on a wheel. Wealth means the wheel turns itself. David's income stopped the moment the deal stalled. He had expenses, but no cash flow. You need to understand the difference between a business and a job. A job is something you do. A business is something that pays you. I like businesses that drown me in cash. I like See's Candies. We bought it decades ago. It requires very little capital. It raises and it sends checks to Omaha. I don't have to make the candy. I don't have to sell the candy. I just cash the check. You need to build income streams that do not require your time. Dividends, rent, royalties. But Charlie, you say, real estate is hard work. Then buy a REIT. Buy a dividend aristocrat. Buy an index fund. I don't care. Just stop relying 100% on your labor. Labor is fragile. Bodies break. Minds get tired. You get fired. If your survival depends on you showing up to work tomorrow, you are not wealthy. You are indentured. I focus on the income my investments produce, not just the price. If I own a stock that pays me a dividend, and the stock price drops 50%, but the dividend remains, I don't care. The check still clears. This is what makes you anti-fragile. If the market closes for 5 years, I should still be able to eat. David had speculative gains, not income. He was betting on the price of condos going up. That is speculation. Investing is buying an asset that produces cash flow. If you are buying Bitcoin, you are speculating. It produces nothing. It just sits there and you hope a greater fool buys it from you for more money. It's rat poison. If you buy a farm, you have corn. If you buy a rental unit, you have rent. If you buy a good business, you have profits. Focus on the cash flow. If the cash flow covers your lifestyle, you become invincible. You can tell your boss to go to hell. You can wait out any recession. Now, why is this so hard for brilliant people to understand? Because real investing is boring. It's like watching paint dry or grass grow. And you people want action. You want to feel like a trader. You want the dopamine hit of the gamble. If you want excitement, go to Las Vegas. At least there the ladies are pretty and the drinks are free. Don't treat your financial future like a casino. We are coming to the end. But this is the most important part. Assume you are wrong about everything. Prepare for the disaster before it happens. David was certain. He was certain the market would hold. He was certain the bank would lend to him. He was certain he was a genius. Certainty is the enemy of wealth. I approach every investment with the assumption that I am missing something. I look for the disconfirming evidence. I try to kill my own best ideas. Darwin used to do this. Whenever he found a fact that contradicted his theory, he wrote it down immediately because he knew his brain would try to forget it. You need to diversify not just your assets, but your scenario. What happens if we have hyperinflation? What happens if we have deflation? What happens if the dollar collapses? I don't know the answer to these questions, and because I don't know, I hedge. I have assets that work in different environments. David bet on one future, a sunny, low interest rate future. When the weather changed, he died. You need redundancy. In engineering, you never build a bridge with exactly the strength needed to hold the trucks. You build it to hold 3 times the weight. That's called a margin of safety. Your life needs a margin of safety, 2 years of living expenses. Insurance, David skimping on insurance was the act of a madman. Multiple streams of income. Bridges without redundancy collapse. Portfolios without redundancy go to zero. I've paid millions in insurance premiums. I've wasted that money if you look at it through a narrow lens, but I bought the right to sleep at night. And I slept very well while David was crying on the phone at 2 a.m. So here is the prescription, the Munger antidote to your financial stupidity. Stop trying to get rich fast. It's a fool's errand. Avoid leverage like the plague. If you're smart, you don't need it. If you're dumb, it will kill you. Keep 20% of your powder dry. Cash is your oxygen mask. Buy things that pay you, not things you hope go up. Invert the problem. Wake up every morning and ask, what can kill me today? And then don't do that thing. You think today is hard? You think 5% interest rates are high? Let me tell you about the 1970s. Most of you weren't there. I was. Warren was. We were running Berkshire Hathaway right into the teeth of the worst stagflation this country had seen in decades. The nifty 50 stocks, the darlings of Wall Street that everyone said you could buy at any price, collapsed. They went down 80%, 90%. Inflation was running at 12%, 13%. Mortgage rates hit 18%. Think about that, 18% to buy a house. Now, if we had been fragile then, if we had been leveraged, if we had been chasing the hot nifty 50 stocks, Berkshire would have died in 1974. We saw our stock price drop from $90 to $40. Did we panic? Did we sell? Number, because we had structured our affairs to survive. We used that chaos to buy. We bought the Washington Post when nobody wanted it. We bought Geico when it was on the brink of bankruptcy. We could do that because we had the cash and we had the stomach. No, why is this so hard for brilliant people to understand? Because you look at a chart of the past and you say, oh, I would have bought the dip. No, you wouldn't have. Because when the dip happens, it feels like the end of the world. It feels like the market is going to zero. To survive that feeling, you need more than courage. You need the math on your side. You need to know that your debts aren't coming due next week. Let's go back even further. 1929, the Great Depression. There was a man named Irving Fisher, maybe the greatest economist of his time, brilliant man, much smarter than me in 1929. Right before the crash, he said, stock prices have reached what looks like a permanently high plateau. He was wrong, and because he was leveraged, because he borrowed money to invest in his own genius, he lost everything. He died poor. If a genius like Irving Fisher can be ruined by leverage and a lack of anti-fragility, what chance do you have? The only chance you have is to admit that you are not smarter than the market. You are not smarter than history, and you must build a fortress that can withstand the siege, even if the siege lasts for 10 years. Now I told you to watch to the end, and if you're still here, it means you have a chance. But listening is not enough. Knowing is not enough. As the old saying goes, knowing and not doing is the same as not knowing. So, we are going to do something practical. I want you to pause this video if you have to. Go get a pen and a piece of paper. I'm serious. Don't just think about it. Write it down. We are going to audit your financial life right now. I'm going to ask you 5 questions. These are the same questions I would ask David if he had called me before. He lost the $40 million. Question 1. What is your largest single exposure? Look at your net worth. Add up everything. House, stocks, crypto, business equity. Now pick the biggest one. What percentage of your total wealth is in that one basket? If the answer is more than 25%, you are fragile. If you own a business and 90% of your wealth is in that business, you are playing Russian roulette. I understand you believe in yourself. But if that industry changes, if a new regulation comes out, you are wiped out. Write down the percentage. If it's over 50%, draw a big red circle around it. That is your kill zone. Question 2. How long can you hold your breath? If your income went to zero tomorrow, you get fired. Your business fails. The dividends stop. How many months can you pay your mortgage and buy groceries without selling a single asset? Most people can't last 3 months. If you can't last 24 months, yes, 2 years, you are not safe. You are running through a dynamite factory with a lit match. Write down the number of months. If it's less than 6, you need to stop investing and start saving. Forget the stock market, you need a bunker. Question 3. What is your sleep number? How much money hits your bank account every month while you are asleep? I'm talking about dividends, interest, rent, not your salary, not your consulting fees. Take that number and divide it by your monthly expenses. If you spend $10,000 a month and you have $0 coming in passively, your ratio is 0%. You are a slave to your job. If you have $5,000 coming in, you are 50% free. Your goal is 100%. Until you hit 100%, you are in danger. Question 4. What has to go right? Look at your financial plan. What are you assuming? Are you assuming the stock market will return 8% every year? Are you assuming interest rates will stay low? Are you assuming you will keep your high-paying job for 10 years? Now, ask yourself, what happens if the answer is I am ruined? Then the plan is garbage. Throw it out. Write down your biggest assumption and then write down plan B next to it. If you don't have a plan B, you don't have a plan. Question 5. What is uninsured? This is the boring one. This is the one David ignored. If your house burns down, are you covered? If you get sued, do you have an umbrella policy? If you get sick and can't work, do you have disability insurance? Go look, don't guess. Go look at the policy. List the disasters you are naked against. Look at that piece of paper. That paper is your reality. It's not the fantasy you tell your friends at the country club. It's the truth. If you have red circles, if you have low numbers, you have work to do. And don't tell me you'll do it later. Later is where dreams go to die. David thought he would diversify latter. He thought he would reduce leverage latter. Latter never came. Ruin came first. I've spent 99 years trying to be rational. It's a constant struggle. We are hardwired to be emotional, tribal, and greedy. But wealth, true, anti-fragile, generational wealth, is simply the byproduct of rationality. It's about being the person who doesn't go crazy when everyone else is losing their mind. It's about being the person who has the cash when everyone else has only debt. It's about being the person who finishes the race, not because they were the fastest, but because they didn't crash the car. David's story is a tragedy, but it's a useful tragedy. He paid $40 million. You got it for free. Well, for the price of 45 minutes of your time. Don't waste the tuition he paid. Go build something that lasts. Go build something robust. Go build something that when the world shakes, and it will shake, you stand firm. David is starting over at 60 years old. He's working a job. He will never be wealthy again. The compounding clock has run out for him. Don't be David. I want you to take a piece of paper right now. I want you to write down your nightmare scenario. What happens if you lose your job? The market crashes 50% and you get sick all in the same week. If the answer is I go bankrupt, then you are living wrong. Fix it today. Sell the risky junk. Pay down the debt. Hoard the cash. It's not sexy. It won't make you the hit of the cocktail party, but it will let you keep your money. I'm 99. I've seen them all come and go. The crypto kings, the dot-com geniuses, the real estate moguls, they rise like rockets and fall like sticks. Be the oak tree. Grow slow. Put down deep roots. Survive the storm. Now, get off your computer and go do the work. And for God's sake, stop buying things you don't understand.